You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, so this week, we're just going to go back to a little bit more advanced trading, actually. Recently, we had some bad news with Ruth Bader Ginsburg, or the Notorious RBG. She passed away this weekend, one of the great icons in the court system overall and everything that she's done. But with that being said, some of the news has actually driven some of the healthcare stocks down a little bit. So in theory, there's no real fundamental reason why a lot of the healthcare stocks might be going down. So I thought I'd look at a few trades overall, just because when you're thinking about a situation where something may be overdone, what could we do to take advantage of that situation? Now, the market has been going down. If you want to continue to be bearish, implied volatility hasn't really skyrocketed on a few of these, but one of the blue chip stocks in that area is United Healthcare Group. Now, this is not meant to be a recommendation on Options Playbook Radio. We're always just looking at situations that an option strategy seems feasible based off of the price of the underlying, based off of the conditions in the marketplace, and based off of things like implied volatility. So United Healthcare is a $292 stock, a $300 stock. So you're going to get a lot of premium in that underlying just because of the price of the stock. And when you see a lot of premium, one of the things I'd like to look at is actually butterflies. Butterflies are very interesting trades overall. And one of the biggest things about pricey underlyings is that they want time decay. That's one of the things that benefits them. A lot of times around earnings or other known news events, we'll do things like skip strike butterflies to try to get try to buy a or to trade a butterfly for a net credit to your account. We've talked about a lot of those. We haven't talked about a lot of just outright butterflies overall. So in today's edition of Options Playbook Radio, that's what we're going to look at. So since we have an expensive underlying, let's just jump right into the trade. We're just going to buy a standard butterfly on United Healthcare. And we're just going to take a cheap shot. Hopefully it is a little bit overdone relative to the downside, and we can get a bounce back before the end of October. So we're In United Healthcare, one of my concerns is the fact that there are fairly decent bid-ask spreads in that if I'm looking at the 310 strike call, it is trading at 280 on the bid and 330 on the ask. And I should actually mention that we are taping Options Playbook Radio. The markets are closed, so a lot of times spreads will widen artificially. It's Wednesday, the 23rd of September. You should be listening to this on Thursday, the 24th. So we have a little bit wider bid-ask spread. So if I'm doing butterflies, I feel like I can get a little bit, I can work the order a little bit more because we're giving the market makers 3 different legs to trade. So I don't mind a butterfly in an underlying that is a little bit less liquid. Now, if the market's going against you, it might, and you're in a hurry to get out, it might be an issue. But on the front end, when we're getting into the trade, you can work it. And if they don't fill you, you just let it go. Because all we are looking at is a speculative way to play a little bit of upside here on United Healthcare. All right. So with all that said, let's get into the trade. We're going to do the October monthly expiration, the regular monthly expiration in October, which is the 16th. We're looking at buying the 310 call. We're looking at selling 2 of the 320 calls and then buying the 330 calls. Now, as I mentioned, United Healthcare right now is at $292.14. It is down $2.12 on the day. The October 16th expiration has 23 days remaining until that expiration. And if we do this trade, we see that the midpoint of that butterfly is trading for $1. So we're going 10 points wide. We're going to risk $1 on this trade. And if I'm doing this trade and I'm paying $1 for a 10-point wide butterfly, basically, this is going to be an all or nothing trade. If it does continue on down and it doesn't come back by that October 16th date, I'm going to be down $1. And I'll be down $100 for every 1 by 2 by 1 butterfly that I put on. And that's one of the things about doing a butterfly. You can do them so cost efficiently that it's kind of, you can take the concept of it being an all or nothing trade. Now, if you want to say I'm not willing to lose $1, I'm not willing to lose $100 on this strategy, or I'm doing a few more butterflies, so I want to try to manage my risk a little bit more, that's okay. You can do that. My biggest concern here is just realizing that these option contracts overall don't seem to have great markets, a little bit illiquid. They're not bad. They're okay. But I just want you to be aware of that. So if you're trying to manage it and the market's going against you, it might cause a problem on the way out, not necessarily on the way in, because you're going to work that order overall. If you don't get filled at that price, you're just going to move on and go to the next trade. So this is going to be a standard butterfly. It's 10 points wide. The math is very simple here. So the maximum that this butterfly you could ever receive on this butterfly would be that $10. You pay a net debit of $1 for it. So the total upside would be $9 or $900 less commissions for every 1 by 2 by 1 butterfly that you get. Now, if you ever do receive that $9, you should also receive the stupid award for it. Because what does that mean? That means that you rode this trade all the way to the expiration date, 23 days from now on October 16th, and the underlying stock sat right at 320 that entire time, and you never closed it out and took a profit. If I'm looking at a butterfly, especially on expensive underlying stocks, it's hard to make the maximum. You're selling 2 at-the-money option contracts, and in order to receive the maximum, that stock has to be right at the money. So what do you need? Well, you've sold those option contracts. They need to decay. That time value in that option contract needs to go away. So if I'm doing this type of trade and I'm paying $1, if I can double my money or even triple it, if I see it trading for $3, why wouldn't I get out of the trade? I'm not going to hang around and play the hope game and say, I'm such a good stock picker that I can guess exactly where this thing is going to close at expiration. No, you're doing this trade. You're risking $1. If you make $1, you've done well on the trade. And it's just that simple. Why are we doing it? Well, United Healthcare has no real rationale as to why it's gone down, except for some of the news that has happened that is really unbeknownst to United Healthcare overall. And so let's summarize the trade again. United Healthcare is at 292.14. Today is Wednesday, the 23rd. The market is closed. We're going out to the October 16th expiration. All the option contracts have that same expiration, 23 days away. We're going to buy the 310 call, sell 2 of the 320 calls, and buy 1 of the 330 calls. The midpoint right now with the markets closed is at a net debit of $1 to the account. That means our maximum risk is going to be $1 plus commissions. Our maximum upside will be the width of the spread, of the butterfly spread in general, which is 10 points, minus that $1 or $9 less commissions to put the trade on and take the trade off. Okay, now let's just talk a little bit about why the 310 strike call. Why did we pick that underlying call? And it's quite simple. We've talked about this a lot when we look at trades around earnings and the concept of it. And we're just looking at, well, what's the most at-the-money straddle trading for? If we look at that, the 290 strike call and put is trading, and I'm just going to round off here because it's not an exact science, right around $20. So you take 20, you add that to 290, where does that get you? Right about the 310 level. Now, I can adjust that if I go down 5 points. I can actually, maybe pay a little bit more and then have a little bit less range for this underlying stock to move. But if I buy the 310, I'm saying I'm within the expected move. I'm in a range that is plausible by what the marketplace is showing me. So if I'm doing this butterfly, I want that range. I want to be within that area. I don't want to go 5 points higher or 10 points higher. I might go a little bit lower, but then again, I'm trying to take an inexpensive bet on a bounce back in a group that's been beaten up for no major reason, I guess. I say that trepidatiously overall. So a long butterfly is sometimes an interesting, cheaper way to take a shot at a bounce back in an underlying that you think has been beaten up recently. It's a good way to approach it and get the entire trade done for a decent net debit to the account. And because we've reduced our risk by doing the butterfly, it basically is an all or nothing type trade. You can just put it on and say, well, will that underlying make the expected move to the upside? Because once again, expected move has no regard to direction. And if it does, well, this butterfly might be able to pay me out before it's all said and done. Comparatively, if we just bought the 310 call, we're looking at paying $3 for that trade as opposed to $1. So we're only doing about a third of the price, still hoping that stock in 23 days can at least get up to that 310 level and maybe beyond. That's going to be it for this episode of Options Playbook Radio. If you'd like to email me any questions, you can email me directly at theoptionsguy@invest.ally.com. And I've been tweeting a little bit more, so please follow me on Twitter, handle Brian Overby. And may all the options that you bought finish in the money, and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.